What if I told you that one of the most powerful companies in Las Vegas, the company that practically built the modern Strip, has been secretly selling off piece after piece of the city for the past decade? And what's even more shocking, most people have no idea it's happening. MGM Resorts didn't just sell a few properties, they orchestrated one of the largest corporate exits in gambling history, worth over $30 billion. And they did it so quietly, so strategically, that even Vegas locals missed it. Today, we're exposing exactly how MGM dismantled their Las Vegas empire, why they did it, and what this means for the future of Sin City. Trust me, by the end of this video, you'll never look at the Vegas Strip the same way again. I'm going to take you inside one of the most calculated business moves in modern history. This isn't just about real estate deals or corporate restructuring. This is about the systematic deconstruction of Las Vegas as we know it. For decades, MGM Resorts International was the name in Vegas. They owned the Bellagio, MGM Grand, Mandalay Bay, Luxor, Excalibur, New York, Park MGM, and more. At their peak, they controlled nearly 40% of the Las Vegas Strip's gaming revenue. But here's what they don't want you to know. Starting in 2019, MGM began executing a master plan to exit Las Vegas real estate entirely, and they did it using a strategy so sophisticated, most investors, tourists, and even industry experts didn't see it coming. Let me show you exactly how they pulled off the greatest corporate disappearing act in gambling history. Our story begins in October 2019 with what seemed like a routine business transaction. MGM announced they were selling the Bellagio to Blackstone Group for $4.25 billion. But here's where it gets interesting. MGM didn't actually leave the Bellagio. Instead, they signed a long-term lease to continue operating the casino and hotel. On the surface, this looked like a simple cash grab. MGM gets billions in immediate capital, but keeps running their crown jewel property. Industry analysts called it brilliant. MGM gets liquid cash while maintaining operational control, they said. It's the best of both worlds. But what nobody realized at the time was that this wasn't just a one-off deal. This was the opening move in a chess game that would reshape Las Vegas forever. The Bellagio sale did something crucial. It established a blueprint. MGM had figured out how to extract massive amounts of capital from their properties while appearing to maintain business as usual. They could have their cake and eat it too, or so it seemed. Here's what the experts missed. By selling the Bellagio, MGM wasn't just raising capital. They were testing the market's appetite for Vegas real estate at astronomical valuations. And when Blackstone paid $4.25 billion without blinking, MGM knew they were sitting on a gold mine. But the real genius wasn't in the sale price. It was in the lease structure. You see, when you own a casino, you're responsible for maintenance, property taxes, insurance, renovations, and all the headaches that come with owning real estate. But when you lease a casino, all of those costs typically fall to the landlord. MGM had just turned their biggest asset into someone else's liability while maintaining all the profit from operations. They essentially created a money-printing machine with none of the overhead. And that's when they realized, why stop at one property? 6 months after the Bellagio sale, MGM dropped their next bombshell. In March 2020, right as the pandemic was shutting down the world, they sold Mandalay Bay to Blackstone for $2.9 billion. Now, selling a major casino property during a global pandemic might seem insane. Tourism was dead, casinos were closed, and nobody knew when travel would recover. But MGM's timing was actually perfect. Here's why. Blackstone and other major investment firms were sitting on mountains of cash with nowhere to invest it. Interest rates were at historic lows, and traditional investment opportunities were scarce. Vegas real estate, even during a pandemic, represented a rare chance to buy premium assets at reasonable prices. But MGM knew something that Blackstone didn't fully grasp yet. They knew that post-pandemic Vegas was going to be fundamentally different. and not necessarily in a good way. The Mandalay Bay sale included something even more telling than the Bellagio deal. MGM negotiated a lease that included significant operational flexibility. They could modify gaming floors, reduce restaurant operations, and adjust staffing levels without landlord approval. Translation: MGM was planning for a smaller, less labor-intensive Vegas operation. They were preparing for a world where casinos would be less profitable but more streamlined. And again, just like with the Bellagio, MGM maintained operational control while transferring all the real estate risk to someone else. But the most shocking part, the sale price, $2.9 billion for Mandalay Bay, was actually above pre-pandemic valuations. MGM had somehow convinced Blackstone to pay premium prices for a property in the middle of the worst tourism crisis in Vegas history. This wasn't just good business. This was financial wizardry. By 2021, the pattern was becoming clear to industry insiders. MGM wasn't just optimizing their balance sheet, they were systematically exiting Vegas real estate ownership. The third domino fell in May 2021. MGM Grand sold to VCI Properties for $2.5 billion. Now, VC Properties is crucial to understand in this story. VC is what's called a real estate investment trust, or REIT. They specialize in buying casino properties and leasing them back to operators. They're basically the middleman that makes these sale-leaseback deals possible. But here's what's fascinating about the MGM Grand sale. The lease terms were even more favorable to MGM than their previous deals. VCI agreed to an initial lease term of 25 years, with options to extend for another 50 years. The annual rent was structured with built-in escalations that were well below inflation projections. And MGM retained the right to make capital improvements and expansions without sharing the costs with the landlord. In other words, MGM locked in 75 years of below-market rent on one of the Strip's premier locations. But the real kicker? The sale happened just as Vegas tourism was starting to recover from the pandemic. MGM timed the market perfectly, selling at what would turn out to be near-peak valuations while locking in rental rates based on depressed 2021 projections. This wasn't luck. This was strategic genius. And it revealed something crucial about MGM's long-term outlook. They believed Vegas real estate values had peaked, but operational profits could remain stable if overhead costs were transferred to someone else. They were essentially short-selling Las Vegas while maintaining their ability to profit from its operations. Just when you thought MGM was done, they accelerated the process. In December 2021, they announced the sale of Aria to Blackstone for $3.89 billion. But the Aria deal was different. This wasn't just a sale-leaseback. This was MGM testing the market for their most premium, most technologically advanced property. Aria wasn't just a casino. It was MGM's statement piece, a LEED Gold certified, technologically integrated resort that represented the future of Vegas hospitality. If they could sell Aria, they could sell anything, and Blackstone paid premium prices for that future. $3.89 billion made Aria one of the most expensive hotel transactions in US history. But more importantly, it proved that MGM's sale-leaseback model worked even for their crown jewel properties. The lease terms for Aria included something unprecedented. MGM negotiated the right to sublease portions of the property to third-party operators. This meant they could essentially become a property management company within their own former casino. They were creating multiple revenue streams from a single asset they no longer owned. But here's the most revealing part of the Aria sale: the timeline. MGM announced the deal in December 2021 and closed it in January 2022. That's lightning speed for a multi-billion-dollar real estate transaction. It suggests that Blackstone was eager to acquire the property, and MGM was equally eager to sell it. Why the rush? Because MGM saw something coming that Blackstone didn't fully appreciate yet: the end of Vegas's real estate boom. To understand why MGM was in such a hurry to sell, we need to look at what they were seeing in their financial data that the public wasn't. By late 2021, MGM's internal analysts were tracking some disturbing trends. First, Vegas visitation was recovering, but visitor spending per capita was declining. Tourists were coming back, but they weren't gambling as much or staying as long. Second, operational costs were skyrocketing. Labor shortages were driving up wages, energy costs were climbing, and maintenance expenses on aging properties were becoming prohibitive. Third, and most importantly, MGM could see that the pandemic had accelerated a generational shift in entertainment preferences. Younger visitors were more interested in experiences, dining, and shows than traditional gambling. This created a perfect storm: declining gambling revenue, increasing operational costs, and a customer base that was fundamentally changing. But the real estate market hadn't caught up to these trends yet. Investment firms like Blackstone were still valuing Vegas properties based on pre-pandemic models that assumed steady growth in gambling revenue. MGM realized they had a narrow window to sell at peak prices before the market corrected, and they were right. By 2022, several indicators confirmed MGM's pessimistic outlook. Vegas gaming revenue growth slowed dramatically. Several major casino operators reported declining profit margins, and consumer spending surveys showed sustained shifts away from gambling toward other forms of entertainment. MGM had essentially timed the top of the market perfectly, but they weren't done yet. By 2022, MGM had sold over $15 billion worth of Las Vegas real estate in less than 3 years. But the true scope of their exit was even more dramatic than the headline suggested. Let me break down exactly what MGM no longer owned. Bellagio, $4.25 billion to Blackstone. Mandalay Bay, $2.9 billion to Blackstone. MGM Grand, $2.5 billion to VSI Properties. Aria, $3.89 billion to Blackstone. The Mirage, $1.08 billion to Hard Rock International, plus several smaller properties and land parcels. In total, MGM had divested over $16 billion worth of Las Vegas assets while maintaining operational control of most of them through long-term leases. But here's the shocking part. Despite selling off their real estate empire, MGM's stock price actually increased during this period. Wall Street loved the strategy because it generated massive amounts of cash while maintaining revenue streams. MGM used the proceeds to pay down debt, return money to shareholders, and invest in growth markets like online gambling and international expansion. They had successfully extracted the maximum value from Las Vegas real estate while positioning themselves for a post-Vegas future. But the most revealing aspect of their strategy was what they didn't sell: their newest properties and their most valuable land holdings. MGM kept Park MGM, which they had recently renovated and repositioned as a boutique property. They kept their Cotai holdings in Macau, and most tellingly, they kept their undeveloped land parcels in Las Vegas. This suggests that MGM wasn't completely abandoning Vegas, but rather repositioning for a very different kind of Vegas, one focused on smaller, more experiential properties rather than massive gambling palaces. Now, here's where this story gets really interesting and really concerning for Vegas. When MGM sold these properties, they weren't just changing ownership. They were fundamentally altering the economics of the Las Vegas Strip. Think about it. MGM used to be deeply invested in the long-term success of Las Vegas. When they owned the real estate, they had every incentive to maintain the properties, invest in upgrades, and promote Vegas as a destination. But now, MGM's incentives are completely different. As lease operators, MGM makes money from short-term operational profits, not long-term property appreciation. If Vegas tourism declines, that's the landlord's problem, not theirs. This creates what economists call a moral hazard. MGM can maximize their profits by cutting costs and deferring maintenance because they don't bear the long-term consequences. And we're already starting to see evidence of this shift. Since 2022, several MGM properties have reduced their restaurant offerings, scaled back entertainment programming, and deferred major renovations. These decisions make perfect sense for a lease operator trying to maximize cash flow, but they're terrible for the long-term health of Las Vegas. Meanwhile, the new landlords, Blackstone and VC Properties, are financial firms, not hospitality companies. Their primary concern is stable rental income, not guest experience or destination marketing. This creates a dangerous dynamic. The operators are incentivized to cut costs, and the landlords are incentivized to avoid capital investments. The result? A slow, steady decline in the quality and appeal of Las Vegas as a destination. So what does all this mean for the future of Las Vegas? MGM's great exit represents more than just a corporate restructuring. It's a signal that one of Vegas's most sophisticated operators believes the city's best days are behind it. And they're probably right. The trends that drove MGM's decision, declining gambling, revenue, changing consumer preferences, increasing operational costs, aren't going away. If anything, they're accelerating. Younger generations gamble less, prefer experiences over possessions, and have more entertainment options than ever before. The old Vegas model of massive casinos designed to keep people gambling for hours is becoming obsolete. Meanwhile, online gambling is cannibalizing traditional casino revenue, making the expensive real estate of the Strip less valuable. MGM saw this coming and positioned themselves accordingly. They extracted maximum value from their Vegas real estate while the market still valued it highly, and they've redirected their focus toward more profitable opportunities. But what about everyone else? For Vegas tourists, this probably means higher prices, fewer amenities, and a generally less impressive experience as properties age and investment declines. For Vegas workers, it likely means fewer job opportunities and more pressure on wages as operators focus on cost cutting rather than growth. For Las Vegas as a city, it could mean a fundamental transformation from a gaming destination to something else entirely, though it's not clear what that something else will be. The story of how MGM secretly sold Las Vegas is really a story about the end of an era. For decades, Las Vegas was defined by massive casino companies that owned both the real estate and the operations. These companies had every incentive to invest in the long-term success of the city. But MGM figured out how to have their cake and eat it too, extracting the maximum value from Vegas real estate while avoiding the risks of long-term ownership. It was brilliant financial engineering, but it may have marked the beginning of the end for Las Vegas as we know it. The next time you walk down the Strip, remember, you're not just seeing casinos and hotels. You're seeing the remnants of one of the most sophisticated corporate exit strategies in modern history. MGM didn't just sell some properties, they sold the future of Las Vegas. And hardly anyone noticed. What do you think about MGM's strategy? Was it brilliant business or a betrayal of Las Vegas? Let me know in the comments below. And if you want to see more videos exposing the hidden stories behind America's biggest cities and corporations, make sure to subscribe and hit that notification bell. Because trust me, MGM's exit from Vegas is just the beginning. There are much bigger stories coming that will shock you even more. Thanks for watching, and I'll see you in the next one.